Mastercard just received a BIT license from the New York State Department of Financial Services. Visa is already capturing 90% of all on-chain card transactions globally. And Ripple was the first institution to walk through this exact regulatory door back in 2016 on the XRP ledger. Before we get into this, had you already heard that Mastercard received this license? Yes or no in the comments right now. This is not financial advice. This content is for educational and informational purposes only. Always do your own research before making any financial decisions. If you think more investors your age should be seeing this level of global coverage, hit the like button. It helps this channel reach more people who need to understand what is happening. Now let me walk you through exactly what happened and what it means for the thesis you have been holding. For most of the last decade, stablecoins were treated as a product that existed on the edges of serious finance. A stablecoin is a digital currency designed to maintain a fixed value, typically 1-to-1 with the US dollar. You hold one stablecoin and it represents $1. It settles on a blockchain rather than through traditional bank infrastructure. The appeal is direct. The programmability and settlement speed of digital infrastructure, combined with the stability of a currency people already know and trust. The institutional world kept its distance for years. Stablecoins lived inside cryptocurrency exchanges. They were used by traders moving between positions without converting back to traditional currency. And whenever stablecoins came up in serious regulatory conversation, the same question came up. Are these actually safe? That question now has a legislative answer, and that answer has changed what the largest payment networks in the world are willing to do. The debate that circled this space for years most often reached for a historical analogy. Critics compared privately issued digital dollars to the free banking era of the United States, the period before 1863, when individual banks issued paper currency backed by speculative state bonds under inconsistent rules varying from state to state with no federal minimum standard. When those banks failed, the notes they had issued became worthless. People who trusted that private money lost everything. The argument was that stable coins would follow the same path. The Genius Act made that comparison obsolete. It was the first piece of federal legislation purpose-built specifically for stablecoin issuers. Not existing bank regulation stretched over a new product, but a new regulatory regime calibrated to the actual structural characteristics of stablecoins. Under this law, a stablecoin issuer cannot lend money. It cannot use leverage. It cannot operate a fractional reserve. By statute, it is required to hold cash and short-dated United States treasuries on a strict 1-to-1 basis against every dollar of stablecoin in circulation. For every digital dollar someone holds, a full real dollar sits behind it in cash or a treasury instrument, legally segregated from all other issuer operations. Monthly attestations are mandatory. Holders carry a statutory priority claim against those reserves. The reserve list is closed by law. No issuer can reach for higher-yielding, riskier assets. On-chain visibility means anyone can verify the reserve status in real time. It is worth understanding precisely why the design of the Genius Act addresses the historical failure critics point to. Prime money market funds broke the dollar in 2008 because they held commercial paper, short-term corporate debt. When those corporations came under stress, the funds fell below $1 per share. A Genius-compliant stablecoin cannot hold commercial paper. The reserve list is closed by statute. Cash, short-dated United States treasuries, and Federal Reserve eligible repo. What destroyed the prime money market sector in 2008 is legally available to a stablecoin issuer operating under this framework. The regulation addresses the historical failure directly, not generally. This level of structural transparency has never existed for a commercial bank deposit. A commercial bank lends out the majority of your deposit, transforms short-term deposits into long-term loans, runs leverage of roughly 10 to 1, and holds your savings inside a balance sheet you cannot see. A Genius-compliant stablecoin cannot do any of that. The reserve is there, verifiable on-chain in real time, protected by statute. Roughly 90% of M2, the broadest measure of money in circulation, is already privately issued through commercial bank deposits and money market fund shares. Private money has always been the norm in the United States monetary system. The question was never public versus private. The question was whether the regulation matched the actual risk of the instrument. The Genius Act answered that question for stablecoins. The Genius Act also resolves what regulators describe as the singleness question, the assurance that a stablecoin can be redeemed for exactly $1 at the issuer and spent as $1 in commerce. Secondary market price movements on exchanges are normal market dynamics. What matters is redemption value. Par redemption is guaranteed through segregated reserves and statutory priority claims. Every deviation from par value in secondary markets resolves back to par at the point of redemption. The guarantee is structural, written into the law. With that regulatory foundation established, the New York State Department of Financial Services BIT license is the right context for what happened this week. The BIT license is one of the most demanding digital asset regulatory frameworks in the world. Its requirements cover consumer protection, cybersecurity, financial integrity, and operational resilience. It is not a registration or notification process. It is a full license requiring compliance review, demonstrated operational standards, and ongoing examination. It is not easy to obtain. Mastercard just received one. In Mastercard's own language, the approval supports their long-term strategy to engage responsibly with evolving payment and settlement infrastructure, specifically including stablecoins and tokenized deposits. Their statement on the announcement is direct. Clear regulatory frameworks play an important role in building trust and confidence as new forms of digital value move from experimentation toward practical application. One of the largest payment networks on Earth has publicly stated that stablecoins are leaving the experimental phase. Here is the detail that moved past too quickly in the coverage. Ripple was the first company to receive a BIT license for the institutional use case of digital assets. That was in 2016, a decade before this week's announcement. At a time when most institutional investors had never heard of the XRP ledger, when stablecoin infrastructure as a serious concept was barely forming, and when the argument that blockchain would underpin global payment settlement was met with skepticism from nearly every established financial institution. Ripple walked through that regulatory door in 2016, built on the XRP ledger, 10 years before Mastercard did. The door Ripple entered in 2016 is the door Mastercard walked through in 2026. That is not a symbolic observation. It is structural evidence of what a decade of compliance work, regulatory engagement, and infrastructure development on the XRP ledger has produced. The path was cleared first. The world's largest payment networks are now walking it. That pattern, one company establishing the compliance standard years before institutions arrive, is the structural argument the price chart never told. The question that follows naturally is what the on-chain data shows about how this infrastructure has been performing since the regulatory clarity arrived. The 30-day Data from the XRP ledger answers part of that question directly. Stablecoin capitalization on the XRP ledger rose 63.7% in a single month, reaching $823 million. The ledger also posted an 82% increase in its broader growth metrics over the same period, with separate measurements approaching $700 million. Monthly transfer volume on the network climbed 178%. The overall stablecoin market cap on the ledger approached $1 billion. The 30-day stablecoin transaction volume reached approximately $4.33 billion, an increase of roughly 120%. These are not annualized rates or modeled projections. They are 30-day movement figures from one public blockchain. Much of that growth is being driven by RUSD. Ripple's stablecoin was not built as a general-purpose retail product. It was designed from the beginning to meet the compliance requirements of serious institutional settlement, regulated, transparent, and built for the kind of infrastructure that global payment networks actually need. The on-chain treasury fund backing, RUSD, holds over $294 million on the XRP ledger. The Mastercard bit license matters more when you understand that this relationship did not begin this week. In November of last year, Ripple announced a specific partnership with Mastercard, WebBank, and Gemini to bring stablecoin settlement using RUSD into fiat payment processing. The mechanism was defined precisely. RUSD, operating on the XRP ledger, would facilitate blockchain-based settlement between Mastercard and WebBank, the issuer of the Gemini credit card. This was not a separate crypto payment product placed alongside existing infrastructure. This was blockchain settlement placed underneath an existing card transaction system. Then, in March of this year, Ripple joined Mastercard's crypto partner program alongside Binance, Circle, PayPal, and Gemini. The program's focus: cross-border transactions, business-to-business payments, and global payouts, all built around blockchain-based infrastructure connected to global card networks. The BIT license received this week is the regulatory formalization of a relationship that had been developing in documented commercial phases across the prior 12 months. That arc has a specific meaning for the investor who built financial security through decades of patient work. You contributed consistently through years when savings account yields sat near zero, while inflation quietly reduced what those savings could actually purchase. You paid attention to an infrastructure thesis when the people around you dismissed it, not because they had examined the data, but because the mainstream narrative had not caught up yet. The stablecoin ecosystem converging around the XRP ledger is not abstract news for someone in that position. It is a federally regulated one-to-one, reserved on-chain transparent payment network being adopted by the same institutions processing the card transactions you make every week. This is structural validation. It does not arrive through a price chart. It arrives through compliance approvals, commercial partnerships, and transaction volume data. The connection between that patient positioning and the specific infrastructure now emerging is direct. ROUSD, operating on the XRP ledger, is the stablecoin documented in Mastercard settlement discussions. The XRP ledger is the public blockchain at the center of the compliance pathway that began with Ripple's 2016 BIT license and that Mastercard completed this week. For the investor who recognized this infrastructure argument early, when the people around them were skeptical and the narrative had not arrived, the developments of the past 12 months are not a new story. They are the chapter that was always coming. The broader payment figures add more context. Cumulative crypto card payment volumes have reached a record $7.8 billion. Monthly volumes are up 230% since May of 2025. In an environment where price commentary dominated public attention, the actual utility of stablecoins in real payment flows expanded at a rate that received far less coverage than the number deserves. Crypto cards, products that allow stablecoin holders to spend in commerce exactly as they would spend traditional currency, are recording volumes that describe a mainstream payment category, not an experimental one. The global stablecoin market sits at roughly $322 billion. RWA.XYZ, which tracks tokenized real-world assets, puts the relevant segment at roughly $34 billion. In February, the market recorded approximately $1.8 trillion in stablecoin transfer volume. $1.8 trillion moving through stablecoin infrastructure in a single month. That is a transfer volume figure, not a market cap figure. It describes the value that actually moved during 4 weeks. These numbers explain why the Wall Street Journal is asking about systemic risk, why Congress passed the Genius Act, and why the New York State Department of Financial Services is now processing BitLicense applications from one of the world's largest card networks. Here is the data point the initial coverage of the Mastercard announcement largely missed. Visa is currently capturing 90% of all on-chain card transactions through crypto-native infrastructure partnerships, including Jupiter Global, which recorded a significant surge in spending volume over the last 2 months. 90% of an on-chain card market that just registered $7.8 billion in cumulative volume and 230% monthly growth. Mastercard has its BitLicense. Visa holds 90% of the market. Whether the RUSD settlement infrastructure already in place on the XRP ledger becomes the mechanism through which Mastercard closes that gap, or whether another approach emerges, is the question this story does not yet answer. The authorization is in hand. The Ripple partnership across 3 documented phases is active. The XRP ledger metrics are expanding. What the competitive dynamic between Mastercard and Visa inside this infrastructure looks like over the coming months is the chapter still being written. What is already established is this: the infrastructure exists, the compliance framework is in place, the commercial relationships are active and documented, and the 30-day network data shows a system in expanding use by regulated participants operating under the first purpose-built federal stablecoin framework in American history. Hold all of the data points at once, and the pattern comes into focus. In 2016, Ripple received a BitLicense for the institutional use case of digital assets. At the time, most of the financial world had not yet arrived at this space. What that license actually was? Proof of concept? Evidence that blockchain-based payment infrastructure could meet the most demanding regulatory standards available at a moment when no other company had tested whether that was possible. What the Genius Act then did was establish the first federal framework purpose-built for stablecoins. Not bank regulation stretched over a new instrument. A purpose-built regime calibrated to the actual structural risk profile of stablecoin issuance. One-to-one reserves, closed reserve lists, monthly attestations, statutory priority claims, on-chain visibility, a legal prohibition on lending, leverage, and fractional reserve. The framework is structurally more transparent in certain respects than what governs a commercial bank deposit today. On that foundation, the XRP ledger stablecoin ecosystem recorded 63.7% growth in a single month, approaching $1 billion in market cap, with monthly transfer volume up 178% and 30-day transaction volume reaching $4.33 billion. RUSD reserves exceeded $294 million. Ripple formalized a stablecoin settlement partnership with Mastercard, WebBank, and Gemini. Ripple joined Mastercard's crypto partner program alongside Binance, Circle, PayPal, and Gemini. This week, Mastercard received its BIT license from the same regulatory body that licensed Ripple a decade earlier. Meanwhile, cumulative crypto card volumes crossed $7.8 billion with monthly growth at 230% above May of last year. Visa captured 90% of on-chain card transactions. The stablecoin market reached $322 billion. February transfer volume reached approximately $1.8 trillion. Each of these data points has its own news cycle. Each is reported separately, processed separately, and displaced before the next arrives. The pattern only becomes visible when you hold all of them at once. What the pattern shows is a structural convergence. Infrastructure built first on the XRP ledger across a decade of regulatory engagement and compliance work. Legislative framework established next. Partnerships formed and documented sequence. Adoption metrics now confirming that the infrastructure is being used at scale, with 30-day data across every dimension continuing to expand. For the investor who followed this thesis through years, when the mainstream conversation was dismissive, who understood that the relevant question was never the weekly price, but the infrastructure being assembled underneath it, these developments are not a surprise. The institutions have arrived at the same structural conclusion the early investors reached years before them. The XRP ledger is approaching $1 billion in stablecoin market cap. Mastercard is formally authorized and actively partnered. RUSD is integrated into Mastercard settlement discussions on documented record. The question going forward is not whether this infrastructure gets used. The 30-day numbers have already answered that. The question is pace. The question of how the Mastercard-RUSD-XRP ledger relationship closes the gap against Visa's 90% on-chain position is the one this story leaves open, and it is the most important number to watch in the months ahead. Now I want to hear from you. Looking at everything covered today, what surprised you more? The Mastercard BIT license or the fact that Visa already holds 90% of the on-chain card transaction market? Drop your answer in the comments. If this video gave you a clearer picture of what is actually happening, go ahead and like it. It helps this channel reach more people who need to see this. And subscribe so you do not miss the next one. Share this with someone in your circle who is only following domestic crypto news and has no idea what is happening globally. Stay informed, stay positioned. I will see you in the next video.